Welcome to this comprehensive guide on quickly mastering the art of reading candlestick charts. In this video, we'll provide a detailed walkthrough of the key elements you need to understand for effective chart analysis. Now, let's delve into the intricacies of candlestick chart interpretation. Green candlesticks signify bullish trends, indicating that the price has appreciated and moved upwards over the given time period. On the other hand, red candlesticks denote bearish trends, signifying price depreciation and a downward movement. Central to understanding candlestick charts are the candlestick body and the wicks, or shadows. The body represents the price range between the opening and closing prices. It is important to note that the open of a green candle is below the body, and the close is above the body, while the opposite. The red candle opens above the body and closes below the body, while the wicks extend above and below, revealing the highest and lowest points reached during the time period. The size of the candlestick body is a key indicator of momentum. A larger body suggests momentum gain, as the price covered a substantial distance during the period, while a smaller body signifies momentum loss, indicating that the price moved a shorter distance. A particularly small or non-existent body, known as a doji, reveals indecision in the market. Understanding candlestick patterns is crucial, as they narrate a story about the ongoing tussle between buyers and sellers. Traders leverage this information, known as price action, to make well-informed decisions. Now let's put this knowledge into practice with a real-world example. The displayed chart represents the Nasdaq on the daily time frame, where each candlestick corresponds to one day. The date and time are provided for reference, and the vertical bar on the right indicates the price. By placing your mouse at different points on the candlestick body and wicks, you can discern opening, closing, highest, and lowest prices. Now, look at a bunch of green candles in a row. That's an uptrend, meaning prices are going up. Red candles in a row? That's a downtrend, showing prices going down. A mix of both? The market's a bit confused, and it's called a sideways market. So how do we identify an uptrend? First, we have a run followed by a pullback afterwards. If this pattern repeats, this means we have an uptrend, which is defined by higher highs and higher lows. In this situation, we want to buy the pullbacks and sell the highs. Now we need to learn how to identify a downtrend. First, we have a rundown followed by a corrective move to the upside. If this pattern repeats, we have a downtrend, which means a downtrend is formed by lower highs and lower lows. In this situation, it's preferred to sell the rundowns and buy the corrective move. How can you identify a sideways market? Market hits the same highs and the same lows. In this type of market movement, we usually look to sell previous highs and buy previous lows. We are moving on to learn how to identify a trend reversal. The first type of reversal is the uptrend shifting into a downtrend. In this case, we have the normal uptrend pattern formed by higher highs and higher lows, with the next high not being able to break the past, alarming the first sign of weakness. Then price breaks the past low as confirmation of the trend shifting from to the downside. This gives us more confidence to sell after price breaks the past low, as it signals sellers might win the fight. The other type of reversal is the downtrend shifting into an uptrend. In this case, we have the normal downtrend pattern formed by lower highs and lower lows, with the next low not being able to break the past low. This gives us a clue that sellers are losing strength against buyers. Later, price breaking the past high gives confirmation of a trend shifting to the upside. This can give us more confidence to buy after the price breaks the past high, as it signals buyers are currently winning the fight. It is important to know that certain candle patterns can also signal for reversals. For example, the bullish pin bar is a strong reversal candle, indicating a potential reversal to the upside. The bullish pin bar is made from three components: a small green body, a large wick below the body, and a small or no wick above the body. The explanation of the bullish pin bar is sellers taking the price lower instantly, but the lowest price has triggered buy orders. The buyers being stronger, pushing the price up. If a bullish pin bar appears after a downtrend, there might be high chances sellers lost their strength and buyers took control. In this instance, we would look to buy after the bullish pin bar candle has closed. The other type of reversal candle is the bearish pin bar. The bearish pin bar is made from a small red body, a large wick above the body, and a small or no wick below the body. This candle indicates a reversal to the downside. The explanation of the bearish pin bar is as it follows. The buyers pushed the price up aggressively until price hit aggressively sell orders, and sellers took control, pushing the price all the way down. If a bearish pin bar appears after a uptrend, the chances are high that buyers are losing ground and sellers are gaining control. In this situation, we want to look to short after the bearish pin bar has closed. Our third reversal pattern we learned today is the bullish engulfing candle. A bullish engulfing bar is made out of two candles in a row where a green candle completely engulfs the prior red candle. In other words, we first see a red candle, then the next candle is a green candle that completely covers the red candle. The high of the green candle is higher than the high of the red candle. This pattern indicates that there are significantly more buyers than sellers, and the buyers are ready to take the price higher. This is one of the most powerful bullish candles. Pattern number 4, bearish engulfing pattern. A bearish engulfing pattern is made out of two candles in a row. We first have a green candle. Then the next candle is a red candle that completely covers the past green candle. The low of the red candle is lower than the low of the green candle. The psychology of this pattern is as it follows. The buyers were in charge, then on the next candle, opens, the buyers try pushing the price to the upside, but there are a lot more sell orders placed, and price aggressively goes down. This is one of the most bearish patterns. We usually like to sell after a bearish engulfing candle, as it leads to higher chances of price continuing to the downside. The morning star pattern is made of 3 candles and indicates a bullish price reversal. The pattern starts with a red candle that has a big body, followed by a doji that has a small body and large wicks, and finally the last green candle. The last green candle size can give us clues of the pattern's strength. If the green candle is as large as the red candle, there's a good buy opportunity. If it's smaller than the red candle, it's a low probability trade. And finally, if the green candle is way bigger than the red candle, it indicates a very strong reversal to the upside. The evening star pattern is made out of 3 candles and indicates a bearish price reversal. Our first candle is a green candle with a large body and small wicks. Then we have a doji candle with small body and large wicks. And finally, we have a red candle with a big body. In this specific type of pattern, we would like to sell after the last red candle has closed, hoping for high probability of price going lower. If you found this video helpful, be sure to hit the like button and subscribe to our channel to never miss future videos. We are ready to dive deep and share a lot of information on the upcoming videos. Make sure to not miss it. Thank you for watching and have a profitable day, traders.